because this is the one, this is the big one. This is the greatest macro gift of all time to get everybody out of this shit that they're in. So it's there in front of you. So then people are like, yeah, but what do I invest in? I'm like, okay, listen, detune all the noise. There's a bunch of decentralized businesses that sell block space. And they all have different types of block space. One's going, hey, mine's the most secure and the oldest. Somebody else is like, well, mine's the internet computer. And somebody's like, mine's the internet computer, but faster. They're just selling block space. So there's a bunch of companies selling block space or applications on top of that block space. That's all the space is. It's just a technology and it's an adoption. So our job within this is now not get philosophical and tribal about where do I invest in that technology and screw it up. Our job is to maximize the opportunity to the best we can.
In this recent interview on Blockworks Macro with Raoul Pal, we explore the concept of exponential growth in technology and its far-reaching implications. Pal goes into his exponential age thesis, examining how rapid technological advancements are reshaping various sectors, particularly in cryptocurrencies and artificial intelligence. At the time of this discussion, Bitcoin is around $56,000 with under a 1% decrease in the last 24 hours and a 10% decrease in the last 7 days. Pal discusses the current state of Bitcoin, trading with recent fluctuations, and explains its outperformance of traditional tech stocks like the Nasdaq. Pal presents his crypto thesis, emphasizing the transformative potential of digital currencies and blockchain technology in shaping the future of finance and economics. Before we dive into this discussion, don't forget to like, subscribe, and share this channel. Now let's hear more from Raoul Pal.
What we've got here is a global utility, which is blockchain, much like the internet was. Now, unlike any of these global utility networks, trains, road systems, all of this, you couldn't invest in them. But because this is tokenized, you've got a behavioral incentive system to grow the network, which is the more people come onto the network, the more the number go up, the more people come on the network. And therefore, the more capital in the network, the more applications get built, the more the network gets used, right? It's genius. And we've never seen anything like this where we're all part of it. So here we've got this asset class, which is a globally homogenous asset, which doesn't exist. Gold is the only one. But gold, if you go to a village in India, the bid-offer spread is 50%. Here we've got tradable on a mobile phone in India, the Philippines, Fiji, New York, Vancouver, the Cayman Islands, the same thing. And it happens to be the infrastructure layer to the internet for the system, for value and storage. And it's that distributed database, which is a public service utility good. Okay, brilliant. It's a $2.5 trillion market cap today. If we just extrapolate out the trend rate of growth, it gets to $100 trillion by about 2032. Okay, so this is the biggest wealth generating opportunity in all human history. And I try and communicate it, but people don't want to hear it, is the point, right? This is a narrative driven attention space. And so they just want what they can do. I made it very clear all the way through, hey, 90% of my liquid net worth is basically allocated right now to Solana. I moved some from ETH. I don't have much Bitcoin right now. Doesn't mean I don't like Bitcoin. I just think the others go up more. Simple as that. I own a bunch of high-end NFTs that I think I have another thesis about. And then beyond that, I do a bit of speculation and other stuff for the fun of it. But the time horizon thing is, I can see it freaks everybody out. And I've stepped back, and it was only in the last 2 weeks I've realized the risk, the real thing that's going on crypto Twitter, and why the banana zone resonates and why you get this backlash is this is everybody's hopes and dreams. It's everybody. It's yours, it's mine, it's everybody's. And now people, they worry about the cycle. I don't remember Jeff Bezos caring about the business cycle. He just owned his stock. If you're in a secular bull market, there is demand for the good that you produce, in this case, block space, premium block space, then motherfucker, you're trading it. What you should do is buy all the sell-offs. If it goes down 85%, you're like, hell yes. It took me a long time to realize that, because I too was the macro kind of cyclical guy. And I think, well, let's sell it at the top. So I think I can predict somewhat the tops from the everything code cycle and the usual bunch of stuff. But does it really matter? As a 30-year-old, yeah, okay. You might want a house. So there's lifestyle chips. Okay, fine. But I tell you, if you've made a ton of money and you take it off at the high and you nail it, you will not put the same amount back in at the low down 85%. When everybody's calling you a criminal, they're going to shoot everybody involved in crypto. There's going to be the gulags for crypto investors. You're like, I'm not doing it. And you will end up screwing the whole thing up. The other one I was talking to Chris Boniski about is people are really getting concerned about where does the top come? Is it early? Is it normal? Is it, every time it's always been December, but for some reason everyone's freaked out it's going to be a different time now. Okay, fine. And that's because of PTSD. But it's not that. I don't know. We don't know. None of us know. Is it going to be a bubble top? Is it going to be, it doesn't matter. What is the one that scares me is what happens if the correction in 2026, because we don't have 22, we don't have it, beating out of massive inflation and the pandemic stuff. Imagine if we just only went down 40% in Bitcoin and 20% in Nasdaq. This is kind of my favorite probability. Sure, there's a whole bunch of alts that are going to go down 99%. I'm just talking about Bitcoin. Everybody's going to miss the trade because they're waiting for the down 70. The sentiment has always been that ICOs had the same, everybody in the last cycle had PTSD over ICOs. Meanwhile, stable coins are getting adopted by the EU. I mean, the adoption of blockchain technology is undeniable. People, this go back to time horizon. They expect it all tomorrow. Why hasn't Google gone to a Web3 business and Meta? And why is the entire financial system not on new blockchain rails by the end of this week on my blockchain? I'm like, it doesn't work like that. It's all at the margin until it's exponential. So I just think it's a time horizon issue. And people are new to this kind of stuff of understanding both exponentials and long duration assets. But when I look back at my first Bitcoin investment at 200, I mean, what a different world. 200, but you didn't see it then. It's very difficult to see because of exponentials.
As we just heard Raoul Pal discuss Bitcoin outperforming the Nasdaq, Pal emphasizes the potential of established cryptocurrencies like Bitcoin and Ethereum in the current economic landscape. He views crypto as a significant macro opportunity, driven by factors such as currency debasement by central banks. Pal discusses the relationship between the crypto market and the broader liquidity cycle, suggesting that as liquidity improves, cryptocurrencies tend to perform well. He encourages investors to consider a long-term perspective when it comes to crypto investments, highlighting the potential for substantial gains over time. Pal also touches on the risks and opportunities in the crypto space, advising caution with smaller altcoins. Now, let's hear Pal's thoughts on exponential growth in technology and the ongoing liquidity cycle.
What I found over this process was that everybody in macro had been struggling for about 10 years. The odd trade came along, like the buy bonds where diamonds trade, you can make a ton of money on it. But people were struggling because we didn't understand the world. Equities just kept going up and we just couldn't get our teeth into anything because we weren't looking at the right thing. There was a mega trend going on, which was this liquidity cycle. And once you saw it, you realized that everything was correlated to it. So if everything is correlated to it, then it becomes interesting to say, okay, well then, if it's all the same trade, what's the best performing asset? Now, the other really important thing, what I think has happened, and it took me too long to realize this, I'm annoyed at myself, is that the Federal Reserve and all the central banks took away left tail risk. Left tail risk in a global macro view really is a debt deflation, which is when the value of your collateral falls too much that you can't pay for the debts and it gets called upon. And people sell the collateral and you get into this cycle. We had that in 2008. What did they do? Debase the currency. What did it do? Optically make asset prices rise, so the collateral went up. The Europeans did it even harder in 2012. So what they've said, and then we did it again in COVID. So what they've said is, you cannot have a debt deflation. We will not allow it. And we will debase the currency by 8% a year to pay for it. Think of that as a put option that you're paying on the system not blowing up, which is a very different way of looking at it, as opposed to, I can't believe they're robbing me of 8%. If you say, hey, listen, it's a mutualized cost of a put option, and we all pay 8% so the whole system doesn't blow up. Okay, so if we've taken away the left tail and everything is correlated on this debt refi cycle, and they have to debase currency over time to do it, well, this may well be the best macro risk-taking opportunity of all time.
Mhm.
And then when you just break it all down, what I did simply was divided all of the main assets by the global liquidity, or even the Fed balance sheet, whatever measure you want to use, M2 doesn't really matter. Nothing else goes up except the Nasdaq and crypto.
Mhm.
And the Nasdaq since 2011 has done 17% a year returns, and Bitcoin's done 150. So you're like, holy shit. Okay, it kind of makes a mockery of anything else you invest in. Everything becomes suboptimal. So then people go, yeah, but what about the risk return, the volatility? That 150% return is after 80% drawdowns. They're included in that number. Oh, and the longer time horizon you take it, the more ridiculous it is. It's an alien asset class. We've never had anything like this. So I got to the realization too late that there is only one trade. And people hate it. People hate the fact that there's one trade and it's a new asset class. And they want it to return to the old days. They want to trade oil and they want to trade dollar yen and they want to trade. I'm like, it's all irrelevant. If our job as investors is to maximize our profits or protect our wealth, okay, wealth preservation may be marginally different, but if we're profit maximizers, then you owe it to yourself, because if not, every other trade is suboptimal because there's no benefits of diversification, zero.
Yeah.
So the only way with an aging population, so GDP growth is driven by a magic formula. It's really simple, and every economist forgets it just in the mid-curving of being an economist. It's like GDP growth is driven by population growth plus productivity growth plus debt growth. Debt growth is robbing from the future. We blew that up in 2008. All debt growth now is just servicing of old debts. So population growth, productivity growth. Population growth, well, you can extrapolate that into the future. There is no population growth in the Western world. It is just shrinking and shrinking and shrinking. We've got a demographic time bomb that we know. Okay, so how do we get GDP when it gets worse and worse and worse every year? Productivity has been terrible too. Why? Because old people aren't very productive. No shit. It's not difficult to figure this out. And then you peer into the future and say, okay, how do we stop this dynamic? Because if this continues, this whole thing continues in this weird world of debasement and cycles and all of that. And really, it's about technology. It's about the AI and the robots are infinite population. People don't get it yet, but like Amazon has gone from 250,000 robots in 3 years to 750,000 robots. Soon it'll be got past the workforce of Amazon itself in human terms, and these things are 3 to 10 times more productive. So we are replacing an aging human workforce with infinite AI and robots. So what that does is makes a mockery of that magic formula. What, we can have infinite population? Well, the other side of that is, okay, well, infinite robots and AI means an infinite use of electricity and compute. So compute, everybody's solving the electricity side. Well, that is productivity. And productivity, again, I love the mid-curve take of spin to it. It's like the Europeans have no clue what they're doing. They're throwing money at this stupid green energy narrative. They completely understand what they are doing is forcing down the cost of capital into innovation in lowering the cost of electricity. Because fossil fuels over the years, basically, electricity costs have been stable. We haven't really made much progress with that. But we've seen the Moore's law working in EV and solar and in wind and in geothermal and eventually in nuclear. We've got more than enough energy. It just takes time and investment in technology for storage and distribution and all of that. So the Europeans are pouring money in. People don't realize the Chinese have been doing even more. The Chinese, 40% of their entire car fleet is now electric. And so they're all forcing down the cost of energy. So think of the magic formula. You're about to increase population infinitely, and you're about to, over the next 10 years, drop the cost of electricity by 75%. That multiplier is bananas. That you don't need anything else to solve this. Now, we had the same situation in the 1950s, coming out of World War II. We had the crash of 29, which was basically 2008. World War II, let's use the pandemic. Everybody comes back into the workforce. We get the inflation, all of that story. But really, what they did was yield curve control and then let productivity pick it up. Now,
Mhm.
they didn't need the robots because what do they have? They had the baby
Boomers.
boom generation.
Yeah.
They all got born in 1950. It's like us, but birthing the robots now, right? And the AI, it's the same thing. It was like a 30% increase in the global population happened. Well, no shit. It all worked out because GDP picked up, productivity picked up, and the world was solved. We're going to do exactly the same rule book now.
As we wrap up this fascinating discussion by Blockworks interviewing Raoul Pal, let's reflect on the key insights shared. Pal's vision of the exponential age, where AI and crypto converge, presents both exciting opportunities and potential risks for investors. He emphasizes the importance of understanding the liquidity cycle and its impact on various asset classes. Pal also challenges traditional diversification strategies, suggesting that the rapidly evolving tech landscape may require new approaches to portfolio management. We would love to hear your thoughts on some questions. How do you see AI and crypto impacting your investment strategies? What steps are you taking to adapt to these changes? Thank you for tuning in to Only the Savvy. If you enjoyed this discussion, please subscribe, like, and share our video for more engaging content diving into the innovative world of decentralized technologies.